Okay, good evening and welcome back everyone to our Beginners Options Master Course for Options Education. My name is Tony Zhang. I'm the Chief Strategist here at OptionsPlay. And today what we're going to do is we're going to predominantly look at the markets together. We're going to try to take what we've learned over the past few weeks and help you apply them to real stocks and real symbols that we can look at, whether it's to sell options for premium and generate income, or for a directional view, how we can leverage buying options to take that directional view, but do so in a way with limited risk and apply leverage to our directional view. So today is really more of an application learning experience as opposed to teaching. So what I want to do is I want to try to go through as many examples as possible using some real stocks. It's going to give you guys an opportunity to let us look at stocks that you want to look at and show everyone how we can apply options for those specific symbols. So let's go ahead and get started. Now, before I do, just a quick disclaimer. What we're going to discuss here today, we're going to talk about a lot of different symbols. It is purely for demonstration purposes, meaning we are not trying to solicit or recommend that you buy or sell any specific securities. This is meant as a learning experience so that you can see how a professional like myself would utilize options and apply them to symbols that you want us to take a look at. So today, what we're going to do is we're going to go through all of those things, but just to make sure that everyone has access to the tools that I'll be showing you here today, I just want to make sure everyone can sign up using optionsplay.se. If you do not already have access to the platform, it's completely free of charge, courtesy of the NASDAQ Nordic Exchange. You get access to the platform, you get access to education like this webinar, you get access to our video library so that you can look at all of our previously recorded webinars, as well as weekly cover call and short put reports and the ideas that we put out every Monday, Wednesday, and Friday. Now, how many of you currently are receiving those emails on Monday, Wednesday, and Friday mornings where we're... I apologize. Looks like I was kicked off there for a second. If you can all see me again, please type yes into the chat window. Okay. I just want to make sure that you guys see my screen as well. Okay, again, I apologize for that. So what I was saying is that if you guys currently see the weekly Monday, Wednesday, and Friday reports that we're sending out, please type yes into the chat window, and please send us your feedback if you have any thoughts on that. You know, we're producing these reports and market outlooks for you so that you can get a better understanding as to how we're currently viewing the markets, what ideas we're currently looking at. If you have any feedback on thoughts, please make sure that you send us that feedback to info@optionsplay.com, because we want to provide you with not just education, but also ideas and understanding of how to apply these option strategies that we're teaching with real symbols. So these are really great teaching moments to help you understand how we're applying these option strategies to the Nordic symbols. So again, any feedback that you have, please feel free to send that to us. So today we're really spending most of our time looking at the market outlook, looking at trading ideas. You know, for those of you that have been joining us every single Thursday for those market outlooks, Thursday evenings, we've been covering a lot of different symbols. We've been looking at the whole Nordic markets, the Swedish markets, the Danish markets. We've been looking at stuff like the COVID-19 trends. We've been covering a lot of different things, as well as plenty of ideas. You guys have also produced a lot of the ideas that we looked at. You know, a couple of weeks ago, you guys were really into some of the gaming stocks. We took a look at a lot of those. So today we're going to do basically the same thing, where we're going to start off, we're going to give a basic overview of where we currently see the markets. We're going to produce a couple of ideas, but feel free to jump in with any symbols that you want us to take a look at. If you want to supply us with a symbol, just tell us whether you're bullish or bearish, whether you own the stock, or if you don't own the stock. You know, any of that type of information, it's helpful for us to show you how we would utilize options for that specific strategy. And just a quick announcement, you know, this is part 3 of our beginner's master course. So this is the second beginner's master course that we've already created for the Nordic market. So if you've missed the first course, or if you missed, you know, part 1 or part 2 of this course, I highly recommend you to go back and watch those recordings. But the first course, it was really very basic, talking about option contracts, making sure everyone understood the difference between a call or a put. The second course, which is what we're wrapping up right now, speaks to the application of basic strategies, selling calls and puts, buying calls and puts for directional views, selling calls and puts for income. Today, we're going to talk about the application of those strategies, and then we're going to start our first intermediate course in May. So this is where we're starting to get into some of the finer points about options trading, specifically trading psychology. You know, a lot of traders are here because you want to learn how to succeed in trading. And this is one of the most important topics as a strategist for me to teach, is how to think like a successful trader. We tend to find that there's a very distinct trading psychology that's required in order to trade successfully. So I'm going to talk about that on May 13th. I hope that many of you are able to join me, because I think it's one of the most important topics for traders to learn, which is risk and money management. And more importantly, the trading psychology behind risk and money management, how you can stay disciplined as a trader. We're going to talk about strategies 101. We're going to get really into fine-tuning, picking expiration dates and strike prices. We're going to teach you how you can look at all types of strategies. So a kind of a unifying approach to selecting expiration dates and strike prices, regardless of what type of strategy you use, whether you're using simple strategies of just calls and puts or using complex strategies like diagonals, iron condors, and butterflies, how to pick your expiration dates and strike prices, more of a unified approach across all strategies. And then again, another June market outlook session so that we can take what you've learned and help you apply to the real markets. So a lot of great things coming up in May. I hope that you guys are able to join us. And we're hoping to launch also an options education day, a half-day intensive course where me and multiple speakers will be coming on for an afternoon, back to back. We're going to just go from session to session. We're going to cover a bunch of different topics that many times we don't get to cover on some of the options education, bringing you a different approach from multiple professionals to show you how we apply options in our portfolio. Also talking about some of the things that many of you ask questions about, like how do market makers work, and what happens to your order when you place that order, who's on the other side of these trades. We want to bring in different market participants, the exchange, the market makers, to answer those questions, so that, because I tend to find that a lot of traders have these beliefs as far as how markets work, and we want to maybe help confirm or dispel some of those beliefs. I think very important discussion to have for a lot of retail traders. So a lot of great things coming up in May and June, so I look forward to having you guys here for that. So let's go ahead and get started. So today, like I said, I'm going to kick this off by giving you a little overview of the markets, some of the strategies that we're currently looking at, some of the symbols that we're looking at. But this is really a day for you guys. You guys can submit your symbols. You can submit some sectors that you want us to take a look at. You can select. The only thing I'm going to ask for you is that if you're going to give us a symbol to look at, make sure that it's a Nordic symbol, and make sure that you also give us whether you're bullish or bearish on that symbol. And then we're all going to look at it together. We're going to show you how I'm going to show you how I would analyze the symbol, and I would show you how I would trade that symbol, potentially utilizing options. So please feel free to type them into the chat window if you have any symbols that you want us to look at together with together here with OptionsPlay. So I'll start off, and keep in mind, I'll keep in the context of a few things. Number one, I want to talk about short puts. This is the first thing that we learned about selling puts. We talked about covered calls. We talked about debit spreads, which is buying calls and buying calls for a directional view, and buying put spreads for a bearish directional view. So those are the four strategies that we learned in this beginner's master course. I'm going to try to focus our attention across these four strategies here today with everything that we discussed. So again, if you have any symbols that you want me to take a look at, please type them into the chat window. Otherwise, I'm going to start off with just a basic overview of the current markets. So I'll start off by taking a look at, whoops, I apologize. I'm going to start off by just taking a look at the OMXS30. We're going to take a look at the OMXS30 to see what our general directional view of the Swedish markets are. I don't know what's going on with my computer here today. Let's see. Okay, so This is something that we covered last Thursday, but I'm going to talk about it again here. I want to make sure that everyone understands, just from a macro perspective, bigger picture perspective, what we're currently looking at. So the Swedish markets have basically broken out to above that major 1500 level that we've been talking about. That has acted as a fairly major resistance level. Now, 1500, why do I say 1500 is a major level? It's because it's this level right here. I'll draw the line for you so that it makes it a little easier to see. 1500 is just roughly the level that you had touched this bottom here back in August of 2019. It broke below this level and bounced back above that level. So that was a major resistance level that it was fighting against, and once it managed to break above that, that's when we would consider this down move in this particular in the Swedish markets to be over, and that we're starting to resume a more of a neutral view. The markets obviously took quite a few weeks, if you will. Took quite a few weeks to consolidate in this particular space here between 1500 and 1550, and just over the last couple of trading sessions started to break out to the upside. This is predominantly what we've been seeing across all global markets, especially US markets, European markets. We're seeing this type of move to the upside. A lot of this, in my opinion, is due to a few different things. Number one, optimism that countries are starting to reopen their economy and we're going to get back to normal sooner than perhaps the markets may have originally anticipated. There's certainly a lot of the flow of capital into the equity markets comes from the fact that most central banks have flooded the markets with liquidity, backstopping a lot of the potential defaults in the fixed income markets. And many times when you flood the markets with cash, as an investor, you don't want to remain in cash. You have to put that cash to work. And obviously equities is going to be one of the places that is going to benefit from the central banks flooding the markets with liquidity. And we're currently seeing that here in the markets. You know, I will point out some levels here on the Stockholm OMX S30. You know, you have that 1575 level that it managed to break above. There's a little bit more upside, in my opinion, to the 200-day moving average, which currently sits at around 1650 or so. So you still have another, I would say, 50 points to the upside on the OMX 30, in my opinion here. That will likely be more of a grind here. Now, if you look at an hourly chart, this is an hourly chart, as you can see, fairly strong movement to the upside. They're starting to see some exhaustions here, but because, as you can see, as markets continue to move higher, you really don't have momentum moving substantially higher along with it. Momentum has actually been predominantly down to flat. So this is telling me there's some signs of exhaustion here, which means that there's a higher probability of a short-term pullback. But again, if you look at the long-term picture, you might get a short-term pullback here, but likely going to revisit that 1650 level on the broader market. Now, some of the things that we talked about over the past few weeks on our Thursday market outlook, and we're going to talk about this tomorrow night for those of you that are able to join us, is that we've seen a slight outperformance of the Danish markets versus the Swedish markets, which just started to reverse this week. For the month of March, the Danish markets have clearly outperformed the Swedish markets by a fair amount, and I'm saying that just this week, we're starting to see the Swedish markets come back to life. I think part of it is due to the fact that, you know, there was some concerns that with Sweden not locking down their economy as a result of coronavirus, that they were going to lag behind. They certainly have lagged behind from that perspective, but I think they're certainly over the hump right now. And I think investors are starting to see the benefits of that by not locking down fully, that their economy has not suffered as much as the Danish markets, which had a full lockdown. So those are some of the key themes. So going in the next week or so, I would expect that the Swedish markets would continue to outperform the Danish markets. And one of the things that we were looking at is the OMX S30 divided by the OMX C25. And one of the things that I was showing a couple of weeks ago, one of the things that I was showing at least last week was the fact that if you look at this particular chart, the OMX S30 and the OMX C35 historically traded within pretty much a range, meaning one market didn't really outperform the other. It's this pretty standard trading range where the markets kind of just whipsawed between one range or another. There wasn't clear outperformance of one sector versus one market over the other. But starting in the beginning of March, that's really when we did see the Swedish markets underperform the Danish markets for quite some time. And what I pointed out last week was that we started to see the forms of a bottoming formation, which means that we're starting to see the Swedish markets outperform the Danish markets. Again, I think this is due to the factors of the coronavirus. You know, the underperformance starting in March certainly points to the fact that there was concerns from investors that the Swedish markets being not locked down may suffer a longer decline in economic activity, but it seems like that's not the case, and that's why the Swedish markets are now outperforming the Danish markets. So those are the key trends that we're paying attention to. So I'll just see this, you know, I see a few different ideas. Frederica and Kaj already pointed out a couple of ideas. I'm just going to start off with one idea, and then let's start taking a look at your ideas. So we'll start with Frederica. So I'll just start taking a look at Ericsson B. This is one that I brought up in our session last Thursday. This is a telecom company. The reason that we like it is because from a 5G play, especially as economies around the world start to think about reopening their economy. We do feel that a lot of these potential governments are going to invest in infrastructure type projects to ignite economic growth. And, you know, 5G from a technology perspective is on many countries' radar for infrastructure, especially when they're thinking about how to plan for an economy or a country that is better prepared for the next pandemic. 5G is certainly at the core of that, and Ericsson B is clearly at the forefront of building 5G technology, and it would be a benefactor of that. So certainly one of the stocks that we're currently looking at. And what I was telling users on Thursday's webinar is that in the current market environment, you can certainly look at buying call options to take a bullish view. But, you know, one of the things that we learned in a couple of weeks ago is using a call spread. So I wanted to show you how you can potentially utilize a call spread here to trade a bullish view here for a stock like Ericsson. So buying a call option on Ericsson would cost 510 crowns. This is the June 18th, 82.5 call. So a call option that's slightly in the money, an at the money call option, costing you 510 crowns. Versus buying the 82.5 call option for 510 crowns, but then selling a 95 call against it for 50 crowns. So what I'm here is I'm collecting 50 crowns out of the 510, and that's basically reducing my cost on this particular trade by about 10%. So what I've done is I've reduced my risk by 10%. And what that does, that 10% reduction in risk, it does quite a few things. But first, I think the best way to show you is to see how the strategy performs if Ericsson is to rally higher between now and June. So let's say the Ericsson's currently at 83. Let's say we think the stock will go to 90 crowns by the June expiration, which is 50 days away. So in the next 50 days, if Ericsson rallies from 83.5 to 90, then if I bought the call option, which is a bullish strategy, we've learned that. But the only thing that we've learned is that when you buy a call option, you have to look at what is the cost of that call, because the cost of that call helps you determine how bullish do you need to be on Ericsson in order for this strategy to be profitable. So in this particular case, you need Ericsson to move roughly 5 crowns higher. So from 83 to about 83.5 just to break even. So if you think the stock's going to go to 90 crowns, right, as you can see here, you're looking at a 47% return, which is not a bad return for the stock to go from 83 to 90, but certainly not super attractive, right? Especially when you're risking 510 crowns to try to make 240 crowns. That's not the best risk reward ratio, risking 510 to make 240. A much better play here is to utilize a strategy like a vertical spread, because the reason we use a vertical spread is because we're bullish on Ericsson B. But since we have an expiration date here of June 18th, which is only 50 days away, in reality, Ericsson B is unlikely going to go to 120 or 130 during that time. It's going to have some limit as far as how far it can go. So if we can save 10% on risk and save 10% on the cost of the trade, what that does is it boosts our return, because now instead of risking $460, I'm sorry, instead of risking 510 crowns, I'm only risking 460 crowns. And what it does is by selling the 95 crown, I'm collecting 50 crowns. So now if the stock goes from 83 to 90, instead of just making 240 crowns, I now make 290 crowns. I'm making an additional 50 crowns because I sold that 95 crown call that expires worthless. So I keep that 50 crowns. So I'm making 50 crowns more while risking 50 crowns less. So it works on both sides. It increases my potential reward while decreasing my risk. So what that does is it boosts my returns from 47% to 63%. That is the addition that I'm going to be able to increase my profits by while reducing my risk. And that's the important part about why you want to learn how to utilize strategies like that vertical. It's not applicable in all scenarios, but in this particular scenario, I think it's a great strategy to potentially use to reduce your risk and boost your returns if you are correct on the directional view. And more importantly, if I'm wrong, if let's say Ericsson B crashes, let's say 5G doesn't come off the ground, or maybe it gets delayed because there's a second wave of coronavirus. And that's always a risk when we're investing, right? We always want to think about what is the downside? What if we're wrong? And that's really where options, in my opinion, comes into play. Because if I'm wrong, if I bought the stock, I would be risking 960 crowns for every 100 shares. If I bought the call option, I'm risking 510. If I bought the call spread, I'm only risking 460 crowns. So I'm risking the least amount of money here, even if I'm wrong. And that's the key here, is to actually limit your risk. Because by limiting your risk, what's going to happen? When you're right, you're going to get a higher return. And that's what we're seeking for. That's what we're really seeking here when we're utilizing options here for trading. So with that, that's just a very quick example of how I would potentially utilize options for this particular type of trading. So let's take a look at some of the names that you want to take a look at. So Frederica wanted to take a look at Sweet Bank. So let's take a look at Sweet Bank. I believe that's the stock that you're looking at, Frederica. So Sweet Bank's currently trading at 117. So it's up about 3.27%. I will say one of the things that has surprised me a little is how much the financial sector, which has predominantly not kept up with the markets, right? So, if we look at OMX S30, it's rallied quite a bit off those lows. So the OMX S30 have already rallied from those lows, roughly 26-27%, right? So significantly off the lows. If we look at this particular Sweet Bank A, it has rallied less than, let's see, what is it? It has only rallied 14% off the low, so 15%. So almost less than half of what the market has rallied off those lows. So the financial sector has really lagged behind. However, over the last few days, it really has started to come back to life. So Sweet Bank is closed here around 117. I will say that there's a major resistance level here around this 117 level. If it can clear above that, I think you have a pretty nice chance of this pushing back up to, filling this gap here, which is around the 133 level or so. So you have quite a bit of upside here. And Frederica is bullish on this particular name. So one of the things I'm going to first do is I'm going to switch this to I'm bullish so that we can take a look at a bullish strategy and see that if I bought 100 shares of the stock, I need 11,690 crowns. Buy a call option here, it cost me 740 crowns. Buying a call spread, 690 crowns. So remember, if I buy a call option here, 115 call, and I'm paying 740 crowns, that means that I think that the stock by June 18th, which is 50 days away, the stock will be 7.4 crowns above 115. So what is that break-even price? It's 122.41. Now I said that, if this stock breaks above 117, I could see this rallying up to that 132 level and filling that gap. So let's say we do get that move to the upside. Now, I do think that's a pretty big move to the upside, but again, financials have been really rallying very strongly here. It's possible. I'm not saying that it's going to happen, but it's possible. So let's take a look at this. So we have the 115 call here that we purchased for 740 crowns. The vertical here is also buying the 115 call option for 740, but at the same time, we're going to sell a 132.5 call option and collect here half a crown. So total cost 690 crowns. So I've increased my break even, or improve my break even by 0.5 crowns here. So not a whole lot, but let's see what the difference here. So let's go back to our P&L simulator, and let's say that by June 18th, the stock is trading at 132. If I had bought the call option, I would be looking at a very nice 129% return. That's a pretty nice return. Certainly much better than the Ericsson B example. The call vertical here looks at a 1,010 crown profit, but that increases my return from 129 to 146, because not only did I increase my reward by 50 crowns, I also reduced my cost by 50 crowns. So my actually total delta on the trade between these two is actually 100 crowns. And that's the difference between 129% return and 146% return. And the one thing that bugs me a little bit about this trade is the fact that there seems to be a little disconnect right now between where banks are rallying versus where interest rates are, because banks predominantly make their revenues off of interest rates, and interest rates have not budged. Interest rates certainly have not rallied. So that's the one thing that bugs me about this particular trade. So I do have the concern that this rally is going to simply fizzle out and return back down to that prior low, which is roughly around 100 crowns. So I'm going to say just in case, right? Just in case that we're wrong on this, the stock declines back to 100 crowns. If you bought 100 shares, you'd lose roughly 1,700 crowns. If you bought the call option, 740 crowns. If you own the call spread, only 690 crowns. And the goal here, again, is to try to gain the highest reward, not by necessarily seeking the best strategy, but by seeking the strategy that has the lowest risk. By seeking the strategy of the lowest risk is how you can potentially get the highest return. And that's why these strategies on the right, in my opinion, is so important. Another strategy that you can think about if you want to own the stock, right? So, think about this stock, right? This stock was trading at almost 150 crowns here in February. So if you think that back in February, this was a good purchase, you certainly might think that buying it at 113 is a much better price to enter the stock at. So that's really where we can look at selling put options here on this particular trade. Selling put options, what I can do is I can sell a May 22nd 112.5 put option, collect 185 crowns here. That's a discount on the stock purchase of 1.5%. Now, on a stock like this that doesn't move a whole lot, especially banking stocks, you're not able to collect that type of premium, at least without earnings coming up. And the earnings aren't reporting for another 79 days. So this stock doesn't pay a dividend either. So if you own the stock, you're not getting paid any dividends. So here, this is a way that you can potentially own the stock at a cost basis of only 110 crowns, if you will, by selling the 112 puts and collecting 185 crowns for that. So that's just another option to show you how you can potentially take a bullish view on this particular stock if you like owning the stock. Let's take a look. Kaj wants to look at INDU. So this is the industrial stocks also have been underperforming, but started to come back to life over the last few days. So let's say now Kaj is bullish on this particular stock. So let's take a look at this. Now, here's the thing about this stock, right? Buying 100 shares, fairly expensive, 20,000 crowns. Buying a call option, 1,125 crowns. So a little expensive also. Buying a call spread here, 1,110 crowns. Notice the difference between these two. It's very little. There's almost no difference. So let's take a look at why, right? So here I'm paying 11.25 crowns for the 250 calls. And on the 230 calls that I'm selling against it, I'm only collecting 0.15 crowns. So in this particular case, I'm really not getting a lot of premium. I'm not really reducing my risk by much. So this is a trade that I probably wouldn't really trade unless I'm really bullish on this stock. So I don't know what your views here on Kaj. So, looking at levels here, I certainly think that 230 would be a major resistance level. I think you're going to have some trouble here in this let's say the 215 to 223 level, because I think you have a lot of traders who probably have bought this stock in this particular range that, if the stock gets back to that range, you're certainly going to see some selling temporarily, at least at 220, 223 level. So even if the stock made it up to 223, which is the higher end of that range, if you buy this call option, you're looking at about a 60% return. So these call options are fairly expensive, which means that if you do get the move that you're expecting, you're not getting a whole lot of return here. So it's a possible trade, but in my opinion, not as attractive. Ashok wants to look at NetInt. I'm not familiar with that particular name, but let's see if we can take a look. I have no idea what stock this is. Is there another one that has options on this? Nope. So this stock doesn't have options on it. So I'm not going to really spend much time on this. The only thing I can tell you is just from a chart perspective, you have this double top that was originally around 35 or so. Looks like it's just, oh, it fell back. It's down 2.5%, down to 33. So certainly, you know, did not break that double top. I would be more bearish on this particular name, in my opinion, because the fact that it failed on that double top, came back below it, likely means that it's probably going to trade back down at least to maybe this roughly 30 level or so. But again, it doesn't trade options, so I am not going to spend too much time on this. Shuka is asking you a question, but who buys a call option that has 60% profit? Do the buyers on the other side see this as a downside? So Shuka asks a question that I think many retail traders have, is they say, if I buy an option or if I sell an option, who's on the other side of this trade? And if I lose, do they win? Or if I win, do they lose? And that's a common question that a lot of people have. And the answer is, generally speaking, a market maker is on the other side of a trade. And a market maker's role is to create liquidity. Their role is to make sure that there's always a bid price and an ask price. So when you click on a trade, so let's say we go back to that IMBU example here. When you look at a call option and you click on the trade button and you see this bid price and an ask price, that's a market maker putting up those prices, saying that he's willing to sell to you at 11.25, he's willing to buy from you at 9.10. Now, once a market maker executes this trade, right? So in theory, when you buy this call option, he is effectively short that call option. Now, keep in mind that a market maker isn't going to just automatically take the opposite side of every single one of your trades and hope that you're wrong. That's not how market making works. No one would be in the business of market making if they were simply hoping that you would be wrong. So once a market maker sells you a call option, what he does is he takes on that short call option and he immediately hedges his risk on the open market by buying or shorting the underlying stock. And he hedges his trade. So despite the fact that he's short the call, he's hedged that trade with stock so that he doesn't have any actual exposure in the stock moving higher or lower. So once they've executed the trade, they make the spread between the 9.10 and the 11.25 or whatever price you guys agree on for that particular trade, and he generally will offset his risk on that particular trade. A market maker is not on the other side of a trade. A market maker is certainly not going to be sitting there in front of his screens hoping that you lose money so that he makes money. So that is one of the myths that I see a lot of traders have about, you know, whether someone's on the opposite side of their trades. So yes, a market maker initially is on the other side of their trade, but they are immediately hedging off that risk. And chances are, you know, on that given day, maybe you might be buying 10 options from that market maker, while he might be selling those 10 options to someone else. His net trade on those might be 0. So he sold 10 and then bought 10 to someone else, and his net, generally speaking, will net out close to 0. So don't worry about market makers making or losing money on the back of your trades. It's a very common question that we get, but I hope that helps you better understand how these trades actually work once you execute them. So Sij is asking for ABB, and I'm sorry if I pronounce your name incorrectly. ABB. Let's take a look at that. And are you relatively bullish? Okay, so ABB, I would say this stock chart looks pretty similar to most stocks, and I'll blow it up here a little easy so that people can see a little easier. Now, ABB, I think, in my opinion, again, follows a chart pattern similar to most stocks, where you've had a pretty significant decline, and then since that decline, what you've had is kind of this triangle, if you will. And I'll draw the triangle so it's a little easier to see. And what the triangle looks like is you have a resistance level here around 19 or so, and then it continues to test this rising support level and just broke out here today. So what this tells me is that this might be on the move here. Now, there's the 200-day moving average right around 2170 or so, 2180. So, it's trading at 1920. So you have about a 1.5 crown move to the upside here for ABB. So not a huge amount of upside before you start running into some major resistance. Whoops, sorry. This was the wrong stock that I was looking at here. This is the right stock. So exact same one. It's just this is the Swedish one versus the ADR, but very similar setup here. The exact same chart I was showing you here before. You have this rising support, consistent resistance here around 190. It looks like it's just starting to break out to the upside. But my concern again is that you have this major 200-day moving average here coming in right around 200. 200 psychologically also is usually a level that we want to pay attention to as well. So concerns there about how much upside there is. I do agree with you that I'm bullish, but I think that you're going to run into quite a bit of resistance here around 200. But let's just take a look at this. Let's say we're bullish, buying a call option on this 190 crown stock, 19,000 crowns to buy 100 shares, 970 crowns to buy a call option, 845 crowns to buy a call spread here. So what we want to do is we want to show you that, if the stock rallies up to 200, which is that resistance level we're talking about, notice how little return there is. If the stock rallies another 10 crowns, you're looking at 3% return. That's not worth it, in my opinion. Even the 18% return, not worth it. This is just telling you a call option here is very expensive. Now, if you're very bullish on this and you think that this is going to make it all the way up to 220, which is this level here, I think you're going to have some resistance here around 215, a little bit of resistance here around 220. So if you think it's going to make it all the way up there and blow through that 200-day moving average, then I think you have a different story here, because at 210, even at 210, you're looking at 100% return. So, you said you're relatively bullish. So I would ask yourself, do you think the stock's going to make it all the way back to 210? Or do you think it only reach 200? Because that's going to help you decide whether or not you want to buy a call option or not. Because obviously if it reaches 210, you're looking at a really nice 136% profit here. If you think that you are want to buy the stock, you can certainly look at selling a put option. This generates 1.26% discount on the stock purchase, which allows you to buy the stock at around 182 crowns, which is about 8 crowns cheaper than where you are currently trading right now by selling a put option. That's one strategy that you can utilize here for this particular stock. Net B equals betting. Okay, so we're not spending much time on Net B because it doesn't have options on it. Someone wants to look at Skanska. So Skanska is interesting. Skanska is interesting because this is an industrial play. Now, Skanska had this big move to the upside and then a quick reversal today. So let's take a look at this. SKAB. So yeah, so this is exactly what I had concerns about the previous stock, right? Where you make a run up to that 200-day moving average and then immediately get rejected off of that 200-day moving average. That's exactly what we just saw today here in Skanska. Now, I will say that, today's price action is, I wouldn't say weak, and this does set this up potentially for a break higher. So, it really depends on whether you are bullish on this particular stock. It is concerning to me that on a day like this where the OMX S30 is up, what is it? When the OMX S30 is up over 2%, that you have a stock that is down 3%. That type of weakness, relative strength. Actually, it looks like it's, this was because of earnings, right? So earnings was yesterday. So there we go. So you had earnings that beat earnings, and then the stock came down after earnings today. But it did get rejected at that 200-day moving average. So, very important level to keep an eye out for many stocks that are going to run into this resistance level, because a lot of stocks have rallied significantly off those lows, usually 20, 30%. Most stocks have rallied off that 20, 30% move. They're going to start running into this 200-day moving average. They're going to start running into investors who have purchased these stocks as the stock rallied, who, at this point has a second chance of getting out of those trades without a loss. And trust me, if someone who bought the stock back here in October has an opportunity to sell their stock now for even or a small profit, they absolutely are going to do that, because I don't know many people that are thinking that this market is going to just go like that and continue going higher. So keep that in mind for all of your investments, especially the bullish ones coming up. So let's take a look at Skanska. Now let's say Skanska, you know, is obviously going to benefit from infrastructure spending as countries may start getting back to reopening their economy. I think that there is a possibility that Skanska is going to be one of the benefactors of perhaps larger infrastructure projects that are coming up. Hard to say, because, you know, it's really difficult for us to say how the economy is going to look in Q2, Q3, Q4. That's really how I think I want to think about Skanska here, because if, you know, I live here in New York City, and Skanska is one of the largest infrastructure construction companies here for pretty much any of the major subways, bridges, everything. And if, let's say, you know, things really slow down the next few months, I could see Skanska revenue taking a pretty large hit, as New York is one of their larger cities as clients. So, you know, I'm not sure how much upside there is here, but let's just take a look at upside here. But we can also, I think what's interesting is this person said they're bullish on Skanska long term. Okay, so let's change that a little. Let's say we're bullish long term. So let's modify this, and let's go out to, let's say, March 2021. So let's go out roughly 1 year, and let's take a look at that. So if I was buying, now this is something I haven't covered yet in my teachings yet, but we do plan on covering buying these long dated options. So what we want to do is, let's say we want to compare buying the stock to buying a leap option. So buying 100 shares of this stock costs 18,000, roughly 19,000 crowns. Buying a leap here cost only 3,400 crowns. So a fraction of the cost here, roughly a little over about 20%, a little under 20% of the cost. So what this allows you to do is take a long-term bullish view on a stock like Skanska while only putting up 20% of the capital, which means that you're only risking 20% of the capital. So if you do get some kind of big reversal here in Skanska, right? So let's say things turn out really bad here and the stock really kind of takes a bit of a decline over the next few months as people realize that infrastructure spending is really going to decline. I'm not saying that's going to happen, but I think that's always a risk. So you can say, well, what happens if the stock goes down to 140 by March of next year? If you had bought the stock, you're risking 4,900 crowns. If you bought the call option, you're only risking 3,400 crowns. So you are better off in the worst case scenario. Now you might say to yourself, well, in the best case scenario, let's say Skanska gets back up to that 240 level long term this year, next time this year. If you bought the stock, you would look at a 5,000 crown profit, a 26% return. If you bought the call option, you're looking at 105% return. So that's how you can utilize call options to take a long-term bullish view on a stock like this, okay? So I hope that answered your question for Skanska. Now Michael's asking, can I see delta implied volatility in IV ranks somewhere in OptionsPlay? Great question. So that's something that we're currently in the process of adding, but yes, you can see delta. You can click on the blue arrow, and at the very bottom, there's a button here that says explain strategy and Greeks. You can see that the delta, the theta, gamma, and vega of this particular option. You can see the implied volatility using the volatility slider. So the current implied volatility of Skanska is 27.79%. The IV rank is something that we're in the process of calculating and adding for the Nordic markets, because we need to build a historical database in order to calculate IV rank. So we're in the process of doing that. So it's going to take us a little bit of time to get that data, because there aren't existing sources of that data here in the Nordics. So we're actually building it ourselves. So I hope that answered your question, Michael. So that seems to be the end of the symbols that you guys wanted to take a look at. If there are any more symbols, please type them into the chat window. Otherwise, I just want to say thank you for everyone for taking the time out here this evening and participating and providing your thoughts and ideas. If you have any questions or concerns about how we're utilizing options in this particular trade, please feel free to type them into the chat window. Someone wants to take a look at SOB long-term. Again, long-term, I can't see that symbol, but I think that's a bullish symbol. It's a very small icon, a very small emoji. If you can tell me if that's bullish or bearish, that would be helpful. So long-term bullish on Saab, so aerospace manufacturer. So one of the things that I will say that that concerns me about Saab is the fact that, you know, Saab hasn't really rallied off that low. Let's see how much has it rallied. So 160 to, oh, I'm sorry, I stand corrected. It's rallied 40% off the lows. I guess it just declined significantly further than most of the other stocks. So yeah, this stock looks very similar to kind of Boeing here in the US. Aerospace stocks certainly coming to life over the last couple of days, up 8% today. So yeah, let's take a look at a bullish view, a long-term bullish view here on Saab. So buying 100 shares of the stock, 22,500 crowns. Let's look at a long-term option here. Let's look at a March 2021. I usually like to buy something that's slightly in the money, like this 210 call option. So 22,000 crowns versus 390 crowns. So this is only about 15% of the underlying stock price, which is a great risk management tool from my perspective, because if, let's say, the aerospace industry does not take off and we risk the stock going back down to 160, which is the low here, if you had bought the stock, you're looking at about a 6,500 crown loss. If you bought the call option, you're looking at a 3,900 crown loss. So significantly better risk, in my opinion, to risk 3,900 crowns versus 6,500 crowns. And then if you look at long-term, right, I think, you know, if we look at this chart, certainly this 260 level, this double bottom that you have here, would be an initial target, in my opinion, on a move higher. And I think that target can be hit relatively quickly if you do get this recovery. So I certainly think that you would get it by March of next year. So if, let's say, what did I say, 260? 260. No, 260 is actually not very far, much higher. So if you look at the stock, you're looking at about a 15% return versus a 28% return. But again, I think that's a pretty short-term view on Saab. I think that if you were long-term bullish, you'd probably be shooting more so for the 300 level or so. So, you know, you'd have to ask yourself, how bullish are you on Saab? It's hard for me to say that for you, but if you do get that move up to 300, you're looking at about a 33% return on the stock, which is not bad for a year. But if you bought the call option, you're looking at 130% return here on Saab. So, you know, that's how you can utilize options play to pick any stock, any directional view, any strategy, and be able to look for yourself to see how these strategies perform, because it's really important that not only do you have access to the tools, that you know how to use those tools to perform this type of analysis so that you can quickly make a decision as to, is this a trade that I want to make? And if you do, you can click on the trade button. We've now included this short code, which many of you, when you enter these trade into your brokerage platforms, you need the short code. We've entered the short code for you so that you can quickly find these types of option symbols and be able to enter an order very quickly. We give you the bid-ask price so that you can see what the bid-ask price is. This is all real-time data so that you know that the pricing that you're seeing here is the pricing that you're going to be able to get on your brokerage platform. And this tool is really designed from the ground up to try to make your options trading as efficient and as easy as possible. So with that, again, I just want to thank everyone for taking the time out here this evening. I really hope that this was useful and giving you a better understanding of how to utilize this platform, and more importantly, how to utilize options for your directional views here in the markets, especially as the Swedish markets start to come back to life. I think there are some opportunities. Just again, be very careful, because a lot of stocks are about to come up to that 200-day moving average. I think you're going to see some resistance there. You're going to see some markets kind of reach some equilibrium, you find some selling in those particular areas. So be careful as you're looking for some bullish views here in this particular market. So thank you so much. I hope you guys have a great evening. This is recorded, so we'll make sure that we send out the recording to you right after we finish. So thank you. Have a good night. And I'll see you guys tomorrow, for those of you that are joining me tomorrow night on our Market Outlook webinar every Thursday evening. So thank you so much and have a great night.